why don't you just tell me a bit about yourself, how you came to found Untapped and your journey, I guess.
Sure. So I spent most of my career in tech. I graduated from Stanford undergrad and grad in the early 90s and went straight into tech. So for most of the 90s and 2000s, I was both working in tech and also investing in tech as an angel investor and also investor in various venture funds. But in 2010, I wanted to, quote unquote, do something more impactful. And I decided the right way to do that was to start volunteering. And at that point in 2010, it was right after the earthquake in Haiti. And so I went and volunteered in Haiti and quickly concluded that aid was actually not solving the problem. In the best case scenario, it was a band-aid for many of the issues. And in worst case scenario, it was actually prolonging the issues by not addressing the core economic challenges. And perhaps because I'd already spent almost 20 years in business at that point, I decided that business was the best approach. And so I launched a company with the World Bank, the IFC actually, and the Dutch Development Bank, FMO. We co-funded a decentralized water infrastructure company in Haiti to serve underserved regions of Haiti with clean water. Model works. We serve close to 200,000 people today with clean water. But one of the challenges is that we always had, not always, but it was very challenging to find the capital, the right kind of capital to scale. And it was either these bank loans that didn't make very much sense, or equity financing to finance CapEx growth, which does not make sense. And there really weren't that many options, not only because of Haiti, but just because of the capital-intensive business we were in. And so I really, and at that same time, I was doing quite a bit of investment in other parts of the world, including Africa. And I noticed that there's this really untapped opportunity to finance capital-intensive businesses in emerging markets because of how broken the financial system was there. As I like to joke, you can borrow $500 to buy a cow, or you can borrow 20 million to set up a power plant, but anything in between, you're out of luck. That's where my company in Haiti sat, right? And I discovered again that this wasn't just a Haiti problem. It wasn't just a water infrastructure problem. It was a problem across emerging markets with the financial institutions and the financial sector in general. Millions of entrepreneurs, millions of successful businesses were being excluded from the financial system because they were informal, or they were just the right size, that they were either too big for microfinance and too small for regular finance. So we set out to do this financing model that could very scalably provide financing to smaller businesses in a way that is both safe and high return. And the way we kind of arrived at that was a bit of an offshoot of my my investing work, because I'd be doing investing in equity in companies in Africa, and I would often come across companies a little bit like my company in Haiti, where I said, well, yeah, great company, doing a lot of great stuff, you're generating cash flow like crazy. I would never invest in that business. Why? There's no exits. It doesn't really scale that much. It's in a market that I'm a little bit scared of, at least from an equity standpoint. You know what? Why don't we do some type of CapEx financing so that you can get the next 100 motorcycles so you can scale your business? And so that's how I got into this revenue-based financing model that essentially allowed me as an investor to capture the cash flow returns of these businesses. And because the financial system is so broken in these countries, the returns were massive. Every dollar that I deployed would create $3 or $4 of value. So it wasn't very difficult to convince entrepreneurs, say, yeah, you keep most of that value, but give me my 30, 40, 50% return, because they can't get the money anywhere else anyway.
Yeah.
And so it was a win-win that worked very well. And so we started down that route. And that's when we also realized that many of these companies were actually implementing technology in their business model. They're using sensors, they're using digital payments, they're using all sorts of tools to make their business run more efficiently, naturally, right? Everything's digitizing like crazy in Africa and other emerging markets. And so we saw this really, I would say, unique, once-in-a-generation opportunity to do this type of financing, which is essentially asset financing, that with a revenue-based return, with a technology base. So we would finance assets that are smart, i.e., that have a digital footprint, that have data coming from it about how it's being used, but also many times is being paid for or operated with digital payments. So now we say, we can do this financing model that makes sense, but we can use technology to scale it. And that's where I think that difference is. Asset financing has been around. Smart assets have been around. You combine the two, combine that with digital payments, and what you've created is a way to finance a completely untapped market that is growing like crazy, which is this smart digital economy that is being run by small businesses, ordinary people, generating cash flow like crazy, solving basic needs like clean water, transport, irrigation, payments, etc. So we said, wow, this is an incredible opportunity to really transform how financing is done in these emerging markets, not just Africa, but in all sorts of emerging markets where the financing systems don't work. And there is a clear divide between those who have, i.e., have the jobs, have the assets and collateral so they can get bank loans, and those who don't have the assets and the W-2 or the pay slips where they can go out and get loans. Those people just don't have a option. Now they do.
Yeah, and I guess this is a unique opportunity in that, as you mentioned, traditional banks haven't been catering to these people, and there's this massive slice of the pie now where I'm presuming they haven't really integrated these kind of digital solutions effectively, and now there's this amazing opportunity whereby, just like we see as well in Western markets, but to a far lesser degree because it's already far more essentially it's far more established. Here you've got a huge basically blank slate in which to start your businesses.
Yeah, what's interesting is that whereas this may be tougher in developed markets, we're really taking a data native approach to risk management and underwriting. What you see with lending in the US that incorporates data, not all of it, there's some really innovative stuff, but what oftentimes banks are doing is saying, oh yeah, let's improve our credit scores by using data. Well, that's nice, but you're still underwriting the same way, which is looking at people's balance sheets and getting their collateral and using a legal contract, and you're still sending a credit officer out there to shake hands with that person. But there's an opportunity in our markets to actually go full digital, full data natively. So the way we assess risk is using data at its core, not just looking at, well, gosh, give me your pay slips. I still don't trust you, so I'm going to put a lien on your house. And then we're going to use a legal contract to make sure that if you don't pay me. Our strategy is designed for emerging markets in a data-driven world that is natively designed to ensure that we get repaid at high rates.
Awesome. Yeah. I mean, rated that, can you give some examples of the kind of businesses which Untapped have invested in?
Yeah, I'll give you three that are quite different. So we finance a lot of mobility. So we got started once with a partner called Flex Club, and they did car subscriptions for Uber drivers. Because if you're in an emerging market like South Africa where they operate, in order to get a car lease, you have to have all the trappings. You have to have a job. You have to have credit scores. You have to have a history, right? So they instead took driving scores, Uber driving scores, to assess the quality of the drivers, and based on that, gave them a car subscription, which we finance. And so we use the car Uber ratings on an ongoing basis and the fares collected to ensure that we get paid. And so
you're
now,
so you're almost piggybacking on Uber's own metrics there.
Or using the data they provide, right? Exactly. And that way they can finance the scale up of their business, Flex Club that is, so that they can serve not just thousands of drivers, but hundreds of thousands of drivers. And now with Flex Club, we're doing delivery services and all sorts of different things in both South Africa, and Mexico. Another example are I can give you a bunch of names, but it's, we have almost a dozen different electric mobility providers. And similar to Flex Club, you know, we're basically providing a vehicle so that the driver can earn cash with that vehicle. But what's interesting about electric mobility is that it's highly complementary to smart asset financing, what we do. Because as you may know, the total cost of ownership of an electric vehicle is much lower than your typical petrol, about 50%, some would estimate. But it's lower because you have lower maintenance costs, you have lower energy costs, you have lower blah, blah, blah. But you as a Kenyan motorcycle taxi driver not that you might understand it intellectually, but you might not be able to realize it because, well, gosh, if it costs me more to buy it up front, then I'm screwed anyway. But we're able to use smart asset financing to essentially transform the per kilometer costs of that vehicle to be less than what it would be for petrol and allow you to pay just that. So you can imagine if I am a motorcycle taxi driver, instead of paying $1 a day for it, I can pay just 80 cents a day. And we're even making more margin. Everyone wins, including the environment. Beautiful. So we are shoring up a whole ecosystem of electric vehicles that essentially allow us to provide drivers with essentially electric vehicles at a lower cost than petrol or gas vehicles, which hopefully will accelerate the transition to electric. And we're doing that across, we're doing that in Ghana, in Uganda, in Kenya, in South Africa, and hopefully many other countries. Oh, let me give you a third example, which we're also very proud of. This is an example, I might even give you a fourth example. So in Nigeria, we finance solar-powered pay-as-you-go refrigerators. So a small merchant will take a refrigerator and it cools their drinks and the food that they resell and so on, but it's solar-powered. And instead of buying the refrigerator and paying the electrical company, which in Kenya, it's intermittent anyway, you pay per hour that you use the refrigerator. So now, I, as a small merchant, can get, let's say I don't have a refrigeration. Now I can suddenly get it and pay for it by the day, by the hour, in fact. And we get repaid directly from the machines because it's all pay as you go. And we get all the data from how much the refrigerators are being used or not being used, etc.